Hello, welcome you all for the course Banking Theory, Law and Practice, under which we are going to see the types of deposit accounts, the topic of the emergence, and also to know the nuances and fundamentals of the deposit accounts and how to open them, how to maintain with the banker. Let's see one by one the customers' accounts with the banker. First of all, we need to know why the customers' accounts are maintained with the banker. Is it any necessity for it? Yes, there is a relationship between a banker and his customer that begins with the opening of an account by the farmer in the name of the later to safeguard the money of the customer, safeguard the funds of the customer with the bank. For such a purpose, the customers go to the bank and banker will make use of the customer's funds for some other purposes to make the revenue. Such revenue will be utilized for giving the benefit back to the customer in the name of interest too. These are all the bank's function which will be seen later. Accepting of deposits of money from the public is one of the essential functions of a banker according to the definition of banking given in the Banking Regulation Act 1949. Initially, all accounts are opened with a deposit of money by the customer and hence these accounts are called deposit accounts. The bulk of the resources of a bank are mobilized by accepting deposits from the public, and by means of which the banker builds a special relationship with customers. The banker solicits deposits from the members of the public belonging to different walks of life, engaged in numerous economic activities, and also having different financial status. The nature of banking and its facilities sought by them therefore varies widely. The banks have therefore introduced different types of accounts with various facilities and privileges. Customarily, we need to know the bank accounts are classified into three categories. One is the savings deposit accounts, two, the fixed deposit accounts, and the three is current accounts. In recent years, new and innovative features in these types of accounts have also been introduced by banks. The present topic that discusses how the bankers are practicing in relation to the opening and operation of different types of customers' accounts. And we need to discuss the measures adopted to regulate the competition amongst the banks in India, particularly in the field of deposit mobilization, for which we need to understand the regulation of competition in banking first. The competition in the business of accepting deposits takes two forms. One form is to improve the customer services, and offer of higher rates of interest to the depositors is other form. How the regulation of competition in banking is happening. The competition in the business of accepting deposits take two forms: to improve the customer services as well as offering the higher rates of benefits. Such competition, though essential for the growth of industry, is undesirable if it becomes unhealthy, so that the healthy competition among the banks must be evolved. And bankers realized the urgency of regulating competition amongst themselves in the field of deposit mobilization. As early as 1958, when the leading banks in the country entered into a voluntary agreement, the interbank agreement on deposit rates prescribed the maximum rates of interest payable by member banks. Modifications in such rates were made as and when felt necessary. After the nationalization of 14 major commercial banks in July 1969, the Reserve Bank of India exercised its right to issue directives to the banks in regard to the deposit rates. The interbank agreement was therefore withdrawn with effect from 1st April 1970. The rates of interest on various types of deposit accounts and other terms, etc. were thereafter prescribed by the Reserve Bank through its directives issued from time to time. A notable feature of the Reserve Bank directives was that the freedom to compete in the banking business was controlled and regulated rather than completely abolished. And it is not also possible to complete abolition of the banking business competitions. The smaller banks with same rates of interest, comparatively less deposits were unable to compete with the bigger banks offering the higher rate of interest. Were unable to compete with the bigger banks, the smaller banks will offer or will try to offer sometimes the amount of interest highly. And because of such conditions, the smaller banks will not be able to pass on or cross on the higher benefit offering banks. The directives of the Reserve Bank, smaller banks were permitted to compete with the bigger ones by offering reasonably higher rates of interest. Thus, both the maximum and minimum rates of interest payable on deposits were prescribed for smaller banks. These banks were at liberty to determine their own rates within the limits prescribed by the Reserve Bank according to their own judgment and discretion. Since 1992, the Reserve Bank has gradually deregulated the interest rates on deposits except the savings accounts, and Reserve Bank of India has permitted the banks to prescribe their own rates of interest on term deposits. Banks are now competing with each other by offering competitive rates and adding attractive and innovative features to their deposit schemes. And the banks are also giving other benefits which are all being offered by banks to attract the term deposits as well as the number of customers. These are all done by the banks only to overcome the competition and also stabilize their business, and both of them will pave the way for the economic growth of the nation. So that the economic growth of the nation is concluded to be depending upon the bank's competition as well as the sustainability and stability of their bank's business. Let's see how the accounts are opened with banks. See, today every customer will go and approach the banks for opening of the accounts, but that was happened before 2000. But after 2000, it has come down to the earth, and the bankers will come and offer their accounts, their offers in the place of the customers by knocking their doors. And they are finding out the customers, they are finding out the deposits, they are finding out the people to whom the loan is to be lent on. These are all the ways of the modern banking. But normally, the accounts are opened with different formalities. A modern banker operates different type of accounts to give the best advantage of convenience and profit to the customer. And a banker operates accounts to suit the requirements of every type of customer, so that the customer will grow like anything and they will get benefit of the bank's proceedings. Let's see what are all the types of bank accounts that are opened and operated. Accounts that are opened and operated by a banking company for the mutual benefit of both the banker and the customer are known as bank accounts, and all such accounts offer several benefits to the customer. Suppose you take savings bank account, which will be offered to the customer even if the customer is not able to maintain the minimum balance, a zero balance account. And some of the savings bank accounts are offered to the customers. Those who are the students of educational institution will be kept with different kinds of transfer facilities and fund saving facilities. And some of the accounts will be kept with the maximum rate of interest of 4.5 or 4. This like different offers are given to the customers by means of different accounts. Such accounts are collectively known as bank accounts. What are all the types of accounts that could be opened with the bank? See, normally the bank accounts may be divided into two, viz. Demand deposit account as well as term deposit account. The demand deposit account is being subclassified into savings account as well as current account. Whereas the term deposit accounts are classified into fixed deposit account and recurring deposit account. The savings account and the current account are coming under the banner of demand deposit account, and the term deposit account, which has two featured accounts called fixed deposit as well as recurring deposit. Let's see what is demand deposit account. A demand deposit account that consists of funds held in a bank account from which deposited funds can be withdrawn at any time, such as checking accounts. The demand deposit accounts can pay interest on a deposit into the accounts but are not required. The demand deposit account allows funds to be accessed any time, while a term deposit account restricts access for a predetermined time. See the key takeaways of demand deposits. The demand deposits provide the money consumers need for purchasing daily expenses, where funds can be withdrawn at any time from the depository institution. Suppose the customer go and deposit 1000 rupees in a day and wants to withdraw back 800 rupees on another day, he may go and take back. Now they are using the card facilities like debit card and credit card and the net banking facility or any payment app, GPay or Paytm, whatever it be. It can be withdrawn at any time from the depository institution from such accounts. The demand deposit accounts can have joint owners, where both owners must sign to open the account, but only one account holder has to sign to close the account. Only one account holder has to sign to close the account. What is joint owner account? Joint owner account is nothing but either or survivor account, which can be opened for the demand deposit schemes. And money market accounts are other accounts that limit withdrawals or deposits, which are not demand deposit accounts. What is term deposit account? A term deposit is a type of deposit account held at a financial institution where money is locked up for some set of period of time. The term deposits are usually short-term deposits with maturities ranging from 1 month to a few years and will have varying levels of required minimum deposits. And such term deposits will be opened with a banker by agreeing to pay the amount in terms of either quarterly or half-yearly or annually or even monthly. Key takeaways of term deposits. A term deposit is a type of deposit account held at a financial institution or bank where money is locked up for some set of period of time which cannot be taken back at regular interval or at the convenience and comfortability of the customer, which can be taken back only at the end of the maturity period unless otherwise they will lose their benefit by means of their deposits. Such term deposits are usually the short-term deposits with maturities ranging from 1 month to a few years. As I said, yearly, monthly, quarterly or half-yearly, annually or up to a few years. Typically, the term deposits offer the higher interest rates than traditional liquid savings accounts, whereby the customers can withdraw their money at any point of time. The fixed deposit accounts. This is the main deposit accounts which gives the maximum benefit to the customers. A type of an account opened by a customer where the money is deposited for a longer period of time and to get a regular income. It is known as fixed deposit account. In this category are included the deposits with the bank for a fixed period which is specified at the time of making the deposit. Such deposits are therefore called fixed deposits or term deposits. A fixed deposit account is safe and fetches relatively a higher return, so that the people will be attracted by means of the offers that are given by different banks for keeping the amount into fixed deposit. The minimum amount of deposit under this type of account is rupees 500. A fixed deposit is repayable on the expiry of a specified period chosen by the depositor and agreed with the bank. It is to suit his purpose and to enable him to get back the money as and when he needs it. Just for an example, I would like to say, if a person intends to utilize his money for any purpose after a few years, he may go and deposit with any bank for 3, 5 or 6 years. Whereas if his purpose is to meet some urgent need in the near future, the fixed deposit may be made for 3 or 6 or 9 months. As the date of repayment of fixed deposit is determined in advance, the banker need not keep more cash reserves against it and can utilize such amount more profitably. The banker therefore offers the higher rate of interest on such deposits because the depositor parts with liquidity for a definite period. The fixed deposits have grown in importance and popularity in India during the recent past. There is no ceiling for the maximum amount of deposit that can be made into this account. These deposits are also called as term deposits. Let's see. The fixed deposits are a high interest yielding term deposit and offered by different banks in India in the recent past to attract a number of customers and to mobilize the amount of deposits for various purposes. The most popular form of term deposits are fixed deposits, while other forms of term deposits are recurring deposit and flexi fixed deposit. The flexi fixed deposit, which is actually a combination of demand deposit and fixed deposit. It has the combined feature of both demand deposit and fixed deposit so as to make the customer aware of the different kinds of deposits that are available with the banks and which will give more benefit to them. So that the customer will go and search for the combining benefits of every kind of deposits and comparatively can choose the right benefit giving deposit scheme. Let's see the rates of interest. The rates of interest and other terms and conditions on which the banks accepted the fixed deposits were regulated by the Reserve Bank of India in exercise of the powers conferred upon it by sections 21 and 35A of the Banking Regulation Act 1949. As already noted, the rates of interest and other terms and conditions are varying between banks and banks. Till April 21, 1992, fixed deposits were classified into 4 categories with varying periods of maturity starting from 46 days. The creation of various categories of fixed deposit with higher rates of interest for each successive category was intended to induce the depositors to take advantage of higher rates of interest by parting with liquidity for longer periods. The Reserve Bank of India revised the rates of interest on fixed deposits several times. So we need to understand the update of the Reserve Bank of India, regularly what they are giving, the instructions for fixed deposits, the rates of interest that are going to be offered or that are recommended to be offered by different kinds of banks and everything. The Reserve Bank of India revised the rates of interest on fixed deposits many times, and during 1991, Reserve Bank made upward revision in the interest rates on deposits twice. Along with rise in the bank rate, the main object of the step was to make bank deposits more attractive as compared to other savings instruments. These steps were undertaken as anti-inflationary measures when the inflationary pressure was mounting up in India. Let me say another important point that since 1992, the Reserve Bank of India commenced the policy of gradual deregulation over deposit interest rates. RBI permitted the banks to prescribe their own rates of interest on fixed deposits of different maturities. But the maximum rate of interest was fixed by it. This ceiling rate was revised several times. In October 1997, the ceiling rate itself was also withdrawn and thus the deposit interest rates were totally freed from Reserve Bank of India's regulations. According to RBI's instructions, permission to offer varying rates of interest for deposits of the same maturity applies to domestic deposits of rupees 15 lakhs and above. The banks are required to disclose in advance the schedule of interest rates payable on deposits. The interest should be paid as per the schedule and should not be negotiated between the banker and the depositor. Consequently, the banks have prescribed their own rates of interest and have also permitted higher rates on deposits above the specified amount, viz. rupees 15 lakhs. On April 19, 2001, the Reserve Bank of India permitted the banks to reduce the minimum maturity period for term deposits to 7 days instead of 15 days. At the discretion of individual banks, this applied to wholesale deposits of rupees 15 lakhs and above, on which banks may offer higher rates of interest. With effect from October 2004, the minimum period of retail domestic term deposits, that is deposits below rupees 15 lakhs, was also reduced from 15 days to 7 days. Till April 1st, 2013, the banks were permitted to offer at their discretion the differential rates of interest on single term deposits of the same maturity of rupees 15 lakhs and above, and also which were called rupee bulk deposits. Since April 2013, first day, this permission is applicable to single bulk deposits of rupees 1 crore and above. So understand, for deposits below rupee 1 crore, the same rate of interest applies for deposits of the same maturity, and the interest should be payable according to a schedule displayed in the bank and should not be subject to negotiation between the banker and the depositor for the benefit of the depositors and customers. Let us see the consequences of the above are pointed out below. Higher rates and deposits above the specified amount of rupees 15 lakhs. Higher rates and deposits above the specified amount of rupees 15 lakhs is one of the consequences of the above point. On 19th April 2001, the RBI permitted to reduce the minimum period for term deposits 7 days instead of 15 days for 15 lakhs and above is another consequence. And with effect from October 2004, the minimum period of retail domestic term deposits reduced to 7 days from 15 days for below rupees 15 lakhs. Till April 1, 2013, the banks were permitted to offer differential rates of interest on single term deposits of the same maturity of rupees 15 lakhs and above, which were called rupee bulk deposits. Since April 2013, this is applicable to single bulk deposits of rupee 1 crore and above, and also for deposits below rupee 1 crore, the same rate of interest applies for deposits of the same maturity. Every customer wants to know the period of deposit, whether to deposit for 1 year or 2 years or 5 years or 6 years, the maximum of 10 years, or for the lesser period of 45 days or 46 days to 60 days or 60 to 90 days, that like every customer is in an intention to know the period of deposit and for which number of period the deposit could be made and what could be the benefit derived from the deposits, for which we need to know the period of deposit, which is normally 15 days to 120 months. The tenure of a fixed deposit may vary from 7 days, 15 days or 45 days to 1.5 years, and it can be as high as 10 years too. It may be varying from bank to bank and also according to the specification of the deposit scheme offered by the banks. Today, every banks are striving for the mobilization of the deposit, and for which they are offering different schemes under different names also. In some of the banks, there will be Young India Plan, Children Plan, or Women Child Plan, Senior Citizen Schemes, or the pension schemes, or pension fund schemes, mutual fund schemes. There are so many deposit schemes that are offered by different banks. And after the existence of the modern private banks, all the banks are competing each other by offering different schemes of deposits to the customers to attract the customer as well as to mobilize the funds. Every customer will come to know definitely once deposited what will be the repayment or the repayment period at which what is going to be matured. For which we need to know that all banks will definitely refuse to repay the amount of fixed deposit before the maturity date. You know pretty well, fixed deposits cannot be taken back unless it reaches the maturity period. Although the banks can refuse to repay fixed deposits before the expiry of the deposit, they generally don't want to repay. This is known as a premature withdrawal. Sometimes if the premature withdrawal happens, there will be a lesser benefit to the customer and more to the banker. In such cases, the interest is paid at the rate applicable at the time of withdrawal or at the time of taking back the money. For example, a deposit is made for 5 years at 8% but is withdrawn after 2 years. If the rate applicable on the date of deposit for 2 years is 5%, the interest will be paid at 5%. Banks can charge a penalty for premature withdrawal in some cases. Income tax regulations require that the fixed deposit maturity proceeds exceeding rupees 20,000 not to be paid in cash. Repayment of such and larger deposits has to be either by account payee, crossed check in the name of the customer, or by credit to the savings bank account or current account of the customer. Generally, the fixed deposits deposited into bank will be given in turn to the customer a receipt, which is called the FDR in short, fixed deposit receipt. Banks issue a separate receipt for every fixed deposit because each deposit is treated as a distinct contract. This receipt is known as the fixed deposit receipt that has to be surrendered to the bank at the time of renewal or encashment. Once the fixed deposit receipt is given to the customer, he has to keep it in safe and also to produce whenever it is asked by the banker, or else at the time of maturity he has to surrender such deposit certificate or the receipt. And the fixed deposit receipt will contain the amount of the interest, rate of the interest, and the maturity amount as well as the period for which it is deposited. It may also contain the nominee of the customer or the depositor. The renewal of the fixed deposits. Every customer wants to renew. Sometimes they are fixed deposits in continuing manner to gain some benefit. Suppose one customer invested 25,000 for a year and it fetches 7% to 8% interest, and after the interest is added, 2,000 rupees interest is added per annum, 25,000 plus 2,000, 27,000, and the customer wants to get it renewed, the 27,000, the principal of the first investment as well as the interest will be invested continuously, called the renewal of FD scheme. Sometimes the renewal may be agreed with the customer, with the banker by the customer at the time of first deposit itself and will be automatically renewed by the banker. If not, it will be intimated to the customer whether to get it renewed or to get it back. In such a case, many banks offer the facility of automatic renewal of fixed deposits where the customers do give new instructions for the matured deposit. On the date of maturity, such deposits are renewed for a similar term as that of the original deposit at the rate prevailing on the date of renewal. What are all the benefits which could be gained by the customers from the fixed deposits? Customers can avail loans against fixed deposits up to 80 to 90% of the value of deposits. The rate of interest on the loan could be 1 to 2% over the rate offered on the deposit. The residents of India or the customers residing in India can open these accounts for a minimum of 7 days. And all the customers investing in a fixed deposit earns a higher rate of interest than depositing money in a savings account. Sometimes the tax saving fixed deposits are also offered by the bank, which are a type of fixed deposits that allow the investor to save tax under section 80C of the Income Tax Act. And what are the taxability of the fixed deposits? We should understand the taxability conditions of the fixed deposits. The tax is deducted by the banks on fixed deposits if interest paid to a customer at any bank exceeds rupees 10,000 in a financial year. And this is applicable to both interest payable or reinvested per customer. This is called the tax deducted at source. With core banking solutions, the banks can tally fixed deposit holding of a customer across various branches and tax deducted at source is applied if interest exceeds rupees 10,000. The banks issue Form 16A every quarter to the customer as a receipt for tax deducted at source. At this moment, the factors affecting the present day interest rates on the term deposits. Though at present the commercial banks are free to determine their own interest rates on term deposits, their decision rests on the following factors. One is the liquidity position or liquidity condition. The overall liquidity in the banking system and the demand for bank credit in the economy is the first consideration. If there is excess liquidity with banks in the midst of slow or subdued demand for bank credit, the low interest rates are prescribed and vice versa. So that the liquidity condition is one among the factor of the banks that affects the present day interest rates on the term deposits, particularly all fixed deposits. The interest rates of small savings is another kind of the factor which affects the interest rate fixation in banks on term deposits. The interest rates offered by government on small saving schemes also influence the bank's decision. Such schemes directly compete with the bank deposits. Hence, the bank deposit rates are generally in alignment with rates on such schemes. If the bank deposit rates are competing the government rate, the banks will get attracted by the customers and more customers will come to the bank for depositing their money. If the small saving schemes of the government offers the higher rate of interest, the people will go to the government schemes of investment and deposits rather the banks. The cost of refinance available from Reserve Bank of India and other Apex banks also determine the cost of funds to banks. The cost of refinance that also fix up the higher rates of interest or lower rate of interest or cost of funds to the banks. If refinance becomes costlier, the banks tend to offer higher rates on deposits. Thus, the bank rate, repo rate and reverse repo rates provide signals to banks in this regard. If the bank rate, repo rate, reverse repo rate are negative, the cost will be high so that the interest rates will be curtailed on the term deposits offered by the banks. The rate of inflation also acts as an indicator, or the rate of inflation is also one among the factors that affects the present day interest rates on term deposits. The rate of inflation that acts as an indicator, and in a period of rising prices, the savers are induced to save and deposit by offering them higher interest rates. In a period of lowering the prices, the savers are going for buying the products whatever they want, or in addition to which they buy some other products, even the products that are all not in need of themselves. This is because of the lowering of price. But normally the rising of prices that happens and the inflationary condition is sustained by the economy. So that the customers will be induced to save their money instead of going for purchase or buying of products, and attracted by the banks with different interest rates. So that such rates of inflation will also affect the present day interest fixation on term deposits, particularly the fixed deposits. Generally, the banks offer higher interest rates on deposit of longer maturities. Higher interest rate on longer maturities. Suppose 7 years the fixed deposit, or 10 years there may be 6.5 or 7%. See, once all the private companies and private organizations before 2000, and particularly say in the midst of 1990, right? The private organizations are approved by the Reserve Bank of India to offer fixed deposits. They offered the fixed deposits at 14% minimum interest rate, as well as the maximum of 23% to 27% with all incentive together, and giving the post-dated checks and all. The customers will be attracted by the private companies. There are so many companies which offered the fixed deposit, then penalized by the Reserve Bank of India after many number of suits made against those companies that are offering. And once the fixed deposits of that companies abolished and vanished or banned, the normal fixed deposits of banks are encouraged to be announced among the customers for making their investment safe. In such a condition, the higher interest rates offered by the deposit institutions or the financial institution should be made available with all consequences, and also to be made aware among the customers whether the institution is right or wrong. The higher interest rates, generally the banks offer such interest rates on deposit of longer maturities, and the interest rate rises as the period of deposit expands. But some banks prescribe higher rates of interest on short-term and medium-term deposits rather than long-term deposits, because they estimate the tight liquidity situation over short, medium periods as compared to medium and long-term. So that who is offering the higher interest rate and for which scheme it is offered, these are all to be carefully scrutinized and analyzed by the customer for investing their funds. And finally, we need to understand the RBI's directives then and there will be the factors affecting the present day interest rates on term deposits, specifically the fixed deposits. As per Reserve Bank's directive, banks generally offer a little higher rate, 0.10 to 0.25% on a single deposit of rupees 15 lakhs or above rupees 15 lakhs. Similarly, these deposits in the names of senior citizens are allowed interest rate higher by 0.50 to 1%. This is the varying rates of interest for the normal customers as well as the senior citizens. The senior citizens are supposed to be allowed to keep their money deposited into bank with different rates of interest offered by different banks. And every bank is striving to collect, mobilizing the deposits, specifically the fixed deposits, offering to the aged people above 60 or 65 they fix, and ask the people to come and deposit at 10.5% per annum or 11% or 11.25, the maximum rate of 11.5. All banks are striving as per the Reserve Bank's directives a little higher interest rate to make out the deposits, collect the deposits, as well as to sustain the customers with offering different benefits. These are all the factors which are affecting the present day interest rates on term deposits, what we need to understand from among the customers' accounts with the banks.